Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, June 7th, 2024. S&P 500 currently sitting at 53.58. I'm David Zarling. I'm here with one of the potential announcers for the Pokemon Championships, Ian McMillan. Welcome back to the show.
That'd be sweet. I think my kid would love that.
I think we all would.
53.58?
Yeah, 53.58.
That would be a all-time weekly closing high.
Yeah, all-time highs seem to get all-time highs.
I would say not the smoothest all-time highs compared to what we've seen over the last 6 to 8 months. I guess we didn't make all-time highs until January, but it's been a rockier path. The
last few months?
Yeah, I'd say like the last 4 to 6 weeks. I mean, had the sell-off in April, rebounded in May, actually got up to fresh all-time highs in mid-May, kind of consolidated there. So looks pretty healthy when you look at the S&P. Underneath the surface, I would say the struggle bus has continued to pick up more passengers.
That's a great way to put it. And when you say that, you just mean the participation of stocks. You know, a lot of people, financial media wise, would say, oh, you know, when they talk about the stock market, they're talking about the S&P 500. They might even be talking about the NASDAQ 100. I don't know who would do that, but S&P 500 seems to be the proxy. But your point is that's a cap weighted index. There's plenty of other stocks in the universe. Not all stocks are doing the same thing.
Yeah, I think that's exactly it. And you've got new relative lows for small caps and mid caps. And you're kind of sitting back, hoping these things turn themselves around. Again, not that they need to for the market to go higher, as we've seen.
Breadth has been kind of lackluster here for a couple months.
It has been. It really has been. I mean, and you could really say, breadth on the NASDAQ peaked in January, and look where we've gone since then.
For sure. And it's interesting, you know, because it's a market of stocks, not just a stock market. And there's different ways to measure it, right? We can measure it by capitalization, large and small. You have a price weighted index like a Dow Jones, and then we can compare that to a Dow Jones transportation average. You have growth versus value, but just looking at a cap weighted basis, right? We have S&P, you just mentioned, making potentially, we'll see where we are at close, making new weekly closing high, but we still have something like small caps using IWM that's still sitting, I would use the term significantly. I don't want to be overly dramatic, approximately 17% below its highs from 2021.
Yeah.
So we're in 2024.
That's so crazy. I think that's the biggest kind of glaring, if you want to call it a divergence in the market over the last, really, this is playing out. We're now into like year 3, year 4 of this playing out. Year 3. And so we just talked about S&P made all-time highs late January. We broke above 4,800. And the Russell is still 17% away from that same, its own respective 2021 highs.
Yeah, the behavioral level, like you've done a good job in past episodes highlighting behavioral market markers. 2021 highs is a significant one, right? We now know, you don't know in the time at the moment that selling is going to outpace buying or that supply is going to outpace demand, but that's the case for small caps. That's not the case for large caps. And there's nothing right or wrong about this. It's just highlighting it. It's saying, I don't really have a problem if Tatum puts up the most points in a championship game. It just is what it is. They're good. all-stars of the league are good. The large cap names of the market are good, but it doesn't mean the rest of the league is good. Because in the end, the hard part about sports is there's one team that's happy at the end. The rest not as happy. And there's some stocks that are unhappy. I don't think they carry emotions, but I know that if investors are holding them as an opportunity cost, and I think you highlighted just a few moments ago that, for example, small caps on a relative basis to the S&P 500 using IWM versus SPY, we are now below the low that had been established where the breadth thrust started in early November 2023.
Yeah, that's a good way to put it.
And so are we going to see, is this a flush? Is this where we see some type of small cap flush and rebound and they lead going forward? We don't know. There's no way to know that.
No, dude, I've been wanting this dude to just get on with it for months at this point, years. And we're at that, right? And it's that neckline that, when you look at 208 to 210 on IWM, you go back to, that was your neckline for basically 2021. And here we are. I mean, polarity kicking in. And I'm sure there's lots of supply out there. This is a huge level.
Yeah, that we're 2 years and 3 months into small caps going nowhere. 0% return. And then if you just take it back to November of 2021, you're at a negative return. So you're talking about 2 years, 8 months, almost going on 3 years of negative return for small caps. I mean, there's children that have been born and learn how to walk during this time frame.
S&P is in that same period where Russell is flat, S&P is up 48%, and that included a not like 9-10 month bear market, and still up 48%. Meanwhile, Russell just flounders. Mid caps have been a lot better. Mid caps made it to all-time highs early March, sitting right there as well. So mid caps, M's easy. If you look at MDY, sitting right on top of its November 2021 highs right now. Obviously, you want to see that hold. Although we broke it in April and came back above. So just a lot of these also just say big ranging consolidations.
Yeah, which is not that crazy to think about. 5 or so episodes ago when we were having a little correction in April, it's just important to remember that where we'd come from. November through April was on a distribution curve, top 1% of moves in market history. And so is it really all that surprising that we continue to see consolidation? And because markets don't move in a straight line, and I would just call it rotational, weak breadth. I mean, there's a lot of stocks that did really well from November through March.
There were.
And here we are. And here we are moving sideways for a few months. Let's not forget the big picture, which you're good at highlighting, is let's not forget where we came from. You mentioned S&P, the IWM being negative 17%. S&P is only up, 12% since its highs in 2021. We're talking about a 3-year return of 12%, not typically the average, not that we hit the average every year, quite the opposite. And after a move like that, why do we get to be surprised by a summer that's consolidating, which does have some seasonality to it? We tend to see consolidation in the summer. I know that June tends to be, based on the work of Ryan Dietrich, tends to be a strong month in an election year.
Interesting.
So we'll see. I mean, that's not a guarantee. It's just something to pay attention to. I have no idea. All I know is that on one hand, you have small caps still 17% off their highs. That could be an opportunity. That might be in the back pocket of the market for breadth expansion. At the same time, when you look at it on a relative basis versus S&P 500 breaking down, it's still an opportunity cost. Meaning, if you have $1 and you have to choose where it's going to go, do you choose the thing that's in an uptrend that's moving faster than another uptrend? Yeah, you don't want to pay the cost of opportunity. Like, you could take that $1, you could invest in S&P, or you can invest in IWM. As of right now, S&P continues to be the index. That's just the reality.
my entire life, dude. The way it feels like.
It does feel like that. It isn't always that way, and I think that goes back to how markets are really good at outlasting. I don't know if you want to call it our temporal psychology or our ability to understand time, because they're 2003 to 2008, small caps value international was the place to be. Like it doubled what the S&P did. S&P was nothing. S&P was a joke for the subsequent years, basically from 09 forward. So all we've known for 15 years is S&P outperformance. And that will change. I don't know when to tell you when that's going to change. I have no idea. Could be. I can tell you that Treasuries aren't operating the way.
Treasuries, man, still just brutal. Tried to make a move. We talked about this in the client letter, but yeah, and we said in the client letter, pretty, we'll see if they carve out a base down here. Maybe that's what we've been trying to do since October of 2022. We'll see. But yeah, getting walloped down again today.
They're no longer offsetting. There's no more risk parity with stocks. So we talk cap weighted quite a bit here between using something like the S&P 500 and small caps from a sector perspective. There's 11 major sectors dividing up the market. If you were to think about a loaf of bread and you slice it up 11 different ways, you've got utilities, technology, industrials, real estate, discretionary, financials, staples. I could go on down the 11. What are we seeing from a sector level currently?
I mean, you got basically 2 to choose from.
All right.
That's about it.
The rest is moldy.
You better make your sandwich with tech and communication services. Those better be the 2 slices of bread you pick.
Yep.
The others are just brutal. I mean, and we never. Utilities, remember when people got real excited about utilities, which I guess, I don't know if it rolled all the way back over, but back below a downward sloping 200-day.
Yeah, I mean, there's always reversion to the mean in any type of trend. And you look at utilities versus S&P, and yes, was there outperformance from March through May? Sure. But that's a very short time frame for investors.
Yeah, and now you've got, what's happened on this, rebound since the beginning of May. Utilities are flat, S&P's up over, basically 3.5%. But yeah, tech, and then you've got relationships like NASDAQ versus Russell 2000 all-time highs, which should be no surprise. That's just continuation of the trend. Goes to speak for the dominance from these mega caps versus the S&P, mega cap growth, all-time highs. Or I'm sorry, mega caps versus micro caps, all-time highs.
So you're using an MGC versus IWC.
Yeah.
Yeah. And the big keep getting bigger. And this goes back to, some will be like, this is unheard of. That's not true. When we look at the 50s and 60s, 1950s and 60s, mega caps were dominant. And that was a rising rate environment. Surprise. The large cap names went on to be the top performers for 20 plus years. Is that the case? I don't know, but you just said that large cap versus micro caps is going out to new highs or close to it. I don't know how you argue, like, why fight the trend? Why do people fight the trend?
I don't know. Couldn't be me.
For fun?
I mean, I used to do it, to be honest.
Oh, yeah. No, we all have.
I mean, that's everyone what probably used to. Some still do.
Yeah, that's what makes you a technician, is you realize, oh yeah, I guess I'm not smarter than the market. I'm not going to stand in the way of a trampling bull herd.
How about industrials fell? That's the part. I was pretty excited about industrials, March, early April.
And you mean on a relative basis?
They're flat.
Nice consolidation here on an absolute basis.
S&P's up 6%. Even the Russell's up almost 2%. So yeah, tough go for the industrials, healthcare. I don't know. I'm sure healthcare will get some type of mean reversion, relative balance here, but same with financials, same with materials have fallen apart on a relative basis.
Yeah, it's definitely become a more narrow market. When we look at the participation of stocks since March, there's been a decline. And really, there's only three ways this resolves, right? You see the large cap names catch down, or you see a broadening out of the market, or you see a continuation of the deterioration, which can go on for months. And large cap stocks can hide a bunch of things. That's just markets. We're not here to say that's good or bad. The fact that Apple is knocking on the door, and I understand Apple just got knocked out of its spot by NVIDIA as the
Yeah, well, I mean, what
second
if
largest.
Apple breaks through 190, whatever, 198 or 200?
Right.
I mean, and it got, oh, I mean,
Right.
it continues to get overbought too.
Yeah. From an RSI
From an
momentum
RSI
standpoint,
standpoint now, of course, okay, like over these little diverging here short term, but
I mean, Microsoft's close to the same thing. NVIDIA has
let us
moved
go
higher.
higher. You can sell as
And
many stocks as you want, but it's gonna be tough. There's some markets though.
well, isn't there something to be said that, for example, if you're looking at the S&P 500, energy is 3.7%, a whole sector. There are one, two, three, four. So energy, utilities, materials, and real estate. All those sectors are awaiting an S&P 500 of 4% or less. And you have five stocks that are larger than those sectors: Apple, NVIDIA, and Microsoft.
Yeah. And
And that's
you know what? I mean, trust me, plenty of people sit around and cry about it. But unless you got a job at Standard and Poor's Global and you sit on the S&P constituency board, can't really do anything about it. So it's the hand you got. Unless you want
yeah,
to be
right.
the dealer of the poker game, this is the hand you get.
And do you really need to bet against the big of the big or the best of the best? Like, why?
Being honest, two of them are sitting on all kinds, and now Nvidia's taken over. You said Nvidia's bigger than Apple now in the S&P, right? So congrats to Nvidia.
For sure. And I still make the argument that it's a household name for industry specific people, those who are in the industry. But my mom hasn't stopped and asked me about NVIDIA. She doesn't even know what it is. So it's going to be interesting to see how this plays out. I mean, trends beget trends, momentum begets momentum. And maybe that's a good place for me to highlight the Adaptive Select ETF, which is listed on the NYSE under ticker ADPV. Supporter of this podcast, helps investors access two of the most prevalent factors in markets: momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. Distributed by Quasar Distributors, LLC. But we've got momentum, and all these things it's why cap weighted indexes even thrive. This goes back to the percentage life episode.
Yeah.
5% on a trillion is bigger than 5% on a billion. That's just math. Like, when these things compound, it's the eighth wonder of the world, compounding. That's momentum. You're going to see these large cap names continue. It's when the large cap names begin to fail, which we haven't seen yet.
Apple tried, but it got a little shaky there, and it's still below a relative 200. And if it breaks out to new all-time highs on an absolute basis, it's going to be pretty big tailwind. On a
For
relative
sure.
basis, we'll see.
These large cap names, in order for them to be distributed, it's going to take years. And you can make an argument for a thesis that the distribution of Apple on a relative basis began in 2020. You can, but we're not breaking important relative horizontal levels just yet.
No.
But there's definitely a divergence between Apple on an absolute and Apple on a relative. And really from a time measurement standpoint, if we're going to see an equivalent move, we're talking about 1,000 days. And 1,000 days takes us all the way.
Like
into
1,000 trading days?
Yes. No, about 690, 700 trading days.
And
But
that's
1,000,
that's about 3 years.
it takes us into 2026. And that thesis is there. The problem is that you're going to sit here and say, now's the time to short the market. Probably not the case, because Apple still would have a ton of time over this 3-year period to move sideways. And that wouldn't necessarily hurt the market if it's moving sideways. If it's holding its weight, it's fine. And you can even have a summer. I think you mentioned a mega cap summer. You can have a summer here where mega caps do well and it covers the negative breath underneath the surface. Perfectly normal. What else are we seeing? What else are we seeing out there? We spent a lot of time talking large and small, very domestic based. Should we talk international stocks? Should we talk bonds?
Yeah.
Where would you like to head with this?
Bonds. I think junk bonds don't look too bad.
And that's a risk on part of the credit market, right? If junk bonds are doing okay.
Yeah. And if you look at them here, take out the cash flows, finish consolidation, man, wouldn't that be something? And if you do total return, they're still sitting at all-time highs. So nothing there yet.
I would say triple C credit spreads are above a 200-day moving average. We haven't seen that since October 2023. I'm not saying that this has to be October of 2023, which is where we saw the breadth thrust re-establish themselves. But there does seem to be some tightening in liquidity going on, that we're above a 200-day. It's a declining 200-day moving average of triple C credit spreads. But as a measurement of liquidity, there has been a tightening of liquidity, and that matches the sidewaysness or the non-trendingness of stocks underneath the surface, with the exception of the mega cap names. So we'll see how that resolves. It's never an all clear. In the past, we've never really given an all clear. We've talked about the table being set for Mr. Market back in late October, early November. Mr. Market showed up to party, didn't ruin the dinner table. We've since consolidated. It's to be determined whether we continue to see the market move higher or consolidate or even break down here. And we're kind of at an overused term, but an inflection point, I think, is a fair way to say it, with the deterioration of breadth underneath the surface. Meanwhile, mega cap healthiness.
Then if you pull up this, triple Y spreads, I mean, they're coming into a rate of trend.
It's still a downtrend in triple G spreads, but they're above a declining 200-day. What does that mean? I have no idea. I'm not here to sit here and say what credit markets have to do or can't do, but there's some tightening of liquidity out there. And it's interesting to see when we look at volatility instruments like the VIX, that we're sitting at 12 and a quarter on the VIX. That's a pretty muted, low volatility measurement. We'll see.
It's down a lot today. I mean, we're back under 13.
And that can melt down over time. I mean, the 11.75 spot on VIX, we haven't broken below that since 2017. So we're going on
amazing
7 years since that took place. So you could see that. And that goes back to the melt up. If we're under that melt up territory where the market just moves higher, like a hot air balloon, it just floats. There's not a lot of volatility. Premiums are low, and it just kind of slowly grinds higher. I'm not calling for that. It's just, that's where we're seeing some of these volatility instruments set up. What about internationally? What are we seeing there?
It's okay. I know it's okay from like participation standpoint. I'm still not giddy about.
Well, EUFN, right? European financials.
Yeah, European financials. You are right. They look pretty. I mean,
they've held steady.
Best areas.
And how negative are we getting if that's taking place? And then you look at emerging markets with kind of a check back using EM back into 4180. We resolve higher out of here. That's to be determined. But if we're going to buy emerging markets, how negative are things? But these things are also in relative downtrends versus US markets. So it might actually prove the case that US markets are going to continue to move higher. Really, if you have $1 to invest, where are you going to put it? Emerging markets versus S&P 500 continues to be in a downtrend since 2010. So we're running on 14 years of a downtrend. Why fight a trend? And if that's going to base out, it's going to take time. Like these type of moves that we see, you're talking about a 14-year move in a downtrend. It's going to take years to build a base to move the other direction. I mean, I guess there always could be a V bottom, like some type of flush. We won't know that until afterwards.
You know what else is falling apart on a relative basis? Gold.
Yeah. It's looking so good.
As it tries to do every year, it tries to do something, puts on a little show, tries to get everyone's attention.
Gets the gold bugs excited.
Yeah. Sends out the job applications. He gets the callbacks, and then he shows up to the outperformance interview.
Yeah. And it's interesting because the dollar, the trade weighted dollars, I would argue has been a hot mess for a while here for 2 years. And obviously gold being priced in dollars, we're going to see how this all plays out. But we're back above a 200-day moving average and something like DXY, a trade weighted dollar. But we're still within a range or a hot mess that goes back to 2022. So we'll see where the dollar ends up. But your point about gold, it tried, but now it's turning into opportunity cost versus stocks. We're back below a relative 200-day moving average, gold versus S&P. Now, when you look at something like gold miners versus gold, probably needs more time. One of those areas that typically when you see precious metals do well, the miners are doing better than metals, probably needs more time. Ian, anything else you'd like to take us that's worth observing that our listeners might appreciate? Anything else you want to highlight before we sign off?
Did we talk about transports?
Yeah, let's talk about that. A couple of weeks ago, Kevin and I talked about Dow theory and how, we still don't have transports at new highs. Definitely divergent from the industrials.
These things just, I don't know, maybe transportation doesn't matter anymore. These things are abysmal. They're worse than small caps.
And you like to see them do well. And these divergences last for a while. We'll see. I mean, the time will tell. There's definitely a divergence there. That's a warning flag that you would have the transportation average not make new highs while the industrial average is. And I know a couple episodes we highlighted how that's kind of the same but different when we look at semiconductors versus software, right? Software has not made new highs while semiconductors have. And so these are divergences that are worth paying attention to, but they can also last months. And we could see resolution out of them higher in the fall. And if that's the case, that would be extremely bullish for the remainder of the year. Time will tell. That's the hardest part. Time will tell. People don't want to wait for time. They want predictions because predictions make them feel good. We don't really have a prediction. We just know that uptrends tend to beget uptrends. All-time highs tend to beget all-time highs. And if we continue to record all-time highs, evidence continues that the uptrend is intact. It's not very sexy. I don't have a better way to say it, but markets tend to trend and we're in an uptrend and that changes. I don't know what else to tell people. All right. Anything else before we wrap it up?
No.
All right. Excellent. Great to be back on here with you. You always do a great job. We'll wait as the data comes in. We'll be back next week. We appreciate everybody listening. And if this is something that you guys appreciate listening to, we really do love it when you share it with others and you give us a thumbs up or a high ranking that helps us get the word out. It's much appreciated, Ian. Thanks for being back on here.
Yeah. Glad to be back. Have a great weekend, everyone.